Welcome everyone to our first quarter 2023 market review. It was a great quarter in the markets with really markets in the U.S. and international rallying to some very strong returns. In the U.S., the Russell 3000 posted a 7.2% return, and in the international markets, we saw a 6.9% return for the ACWI ex-U.S. index. A lot of that driven by the moderating inflation numbers. We've seen inflation now coming down. We're really peaking in June and coming down at the end of last year, well into this year. And that certainly has really given the markets some positive news in terms of what the Fed is doing is working, and hence the rally. We also saw the fixed income markets up 3% for the Bloomberg Barclays aggregate. Again, a lot of that is with rates and the idea that we may be closer to the top of the rate cycle than we were. So rates moderated a little bit, helping fixed income post that 3% return. As we look across the markets generally, the labor market still, though, however, remains tight at 3.5% in March. And that is really the one question, I think, for the Fed. Labor or wage inflation is certainly a key driver for inflation overall, and certainly something that the Fed is going to be looking at as they continue to examine the market to determine how many more rate hikes are necessary. So one key factor to look out for. And again, we'll talk a little bit about the idea of recession, and a lot of people had forecast recession. That went away a little bit. A lot of people are pushing a potential recession back into later in the year. And in fact, some forecasts think that we may have a soft landing here from the Fed and their tightening policy, and in some cases may not even see a recession. So certainly all of that news helped markets out over the quarter. And if we look at those markets with a little more detail, we'll turn to the next slide here. So taking a deeper dive into the U.S. equity markets, we saw risk-based assets outperform, and those are the growth assets, outperform value over the quarter. In fact, large cap growth was the best asset class, up 14.4% versus the Russell 1000 value, which was only up 1%. In fact, the Russell 2000 value, which really denotes small cap value stocks, was actually negative, down 0.7%. This reverses a trend that we had seen recently, which really was value stocks outperforming. You'll see that in the top right-hand chart. And that teal bar which represents value outperforming growth over this rolling time period. And certainly as value now, as growth comes back, that of course represents in certainly the large cap growth space, the FANG stocks that we often hear about: Facebook, Apple, Netflix, Amazon, and Google. If you look at the lower chart reflecting the sectors, again, you'll see this in the best performing sector, represented by information technology for the quarter, up 21.4%. Again, those are all of the tech names, mainly large cap growth names that outperformed and led. The worst performing sector were financials, and that's not surprising. That is where many banks, all the banks reside in that sector. Financials down almost 6% for the quarter. And a lot of that's reflective of a lot of the issues that we saw with some of the regional banks that really started with the Silicon Valley Bank and Signature issues that we saw from those small two regional banks extending out to more of the regional banks and the capital that they had on hand to pay their depositors. Looking at fixed income, or let's look at international equity first. And like US equity, international equity was up strong for the quarter. The ACWI was up almost 7% at 6.9%. And it was really driven by some of the developed markets. And the same theme was found in international that we saw in US, which were large cap growth stocks outperforming. In fact, the MSCI EFA Large Growth Index was up 11.4%, and they led the way. Every really style in the international markets were up and positive, including emerging markets, which, while the poorest performer, was still up 4% for the quarter. So developed markets have continued to outperform emerging markets. You'll see that in the top right-hand slide, represented by the orange bar, which is representative of developed markets when you're above that horizontal axis. Certainly in this environment, when you have higher rates, that makes it a lot tougher for these emerging markets to outperform, and hence why we're not seeing a lot of outperformance in some of these emerging market categories. And then the lower chart represents our international versus domestic performance. US stocks have led the way for a long, long time. This chart goes back to 2011. And if you are below the horizontal axis, that means domestic stocks or US equity is outperforming. Since 2011, only a couple of periods where international has outperformed US. In fact, more recently, we are in one of those periods where international now has been outperforming domestic or US equities. Now let's turn to fixed income and look at the fixed income markets. The broad market up 3% for the quarter, as I already noted. When you look at the different styles and the different sectors in the fixed income market, similar to the US equity market, were the risk-based assets that did outperform. In that lower chart that denotes the sectors, you'll see high yield corporate bonds was the best performing asset class, up 3.6% for the quarter, followed by corporate investment grade, which were two of the riskier fixed income segments in the fixed income market. What I'd like to focus on and speak to a little bit is the yield curve. I mentioned recession when we started, and some of the recession outlook that had started to maybe fade a little bit, certainly be pushed back. And if you look at the yield curve, you'll see where we were 1 year ago and where we are today, which is denoted by the orange color. And the yield curve is inverted. And what does that mean? That means short-term rates are higher than long-term rates. And that typically has denoted a recession, and certainly why we're hearing a lot about recession and why it's in the news, versus a positively sloped yield curve, which signifies growth. That being said, even though it is an indicator, the old adage that the yield curve has predicted a recession 10 out of the last 4 times is accurate. It does not always denote a recession. So something to keep an eye on, to be aware of, to see if long-term rates do continue to go higher, or if in fact the Fed feels that they're done. They control the short end of the curve, and that short end of the curve could come down, which I know the market does expect, certainly over the next year, for the Fed to potentially do, to bring this curve more into an upward sloping fashion. On the next page, we have our Market Kaleidoscope, and really this just speaks to diversification and why participants should be diversified across the board. And year to date, large cap growth up 14.4 is the best performing. The worst performing is commodities, down 5%. Interestingly enough, you'll see that from 2022, the best and worst categories were exactly the opposite, with commodities being the best performing asset class as we finished up 2022 at 16.09, and large cap growth being the worst at 29.14. So maybe not too surprising to see that reversal, but again, this chart really speaks to diversification and why plan participants, even plans, should be well diversified across different asset classes. And as we finish it up here, wanted to supply a chart on the bank outlook that did drive some of the underperformance in the equity markets over the first quarter. And again, that was due to Silicon Valley Bank and Signature Bank and some of the issues that they had, and the rescue that came in from the Fed to rescue those banks, and certainly the thought that this could maybe spread across to some other regional banks. This chart shows banks in general and their tier 1 capital ratios that signifies a bank's financial health. And what we've seen, and really this has been the trend since the great financial crisis since 2008, is that this capital ratio has gradually increased, where it's at a very high level now, between 13-14%. That does suggest that banks are healthy from a capital perspective and able to pay their depositors when called. So really just wanted to point this out. There are definitely some stricter lending standards and capital requirements now that are in place. The scenario that we saw over the first quarter was really not like what we experienced back in 2008. But maybe I guess you could say was really that saying a run on the bank, which when banks are called and there's a flood into these banks to get assets out, sometimes it does become tough depending on what banks are invested in, and why banks really need to be carefully investing the assets when they get them and have sufficient liquidity. So looking at this, all in all, no real issues globally across the banks. And I think we've seen that now really start to moderate a little bit some of those bank issues that we saw over the first quarter, and things start to calm down there. That is it for our first quarter market review. Certainly a lot of interesting things that we'll see coming up here in terms of what the Fed does, in terms of rates and where the inflationary numbers go. We hope to see everyone soon. Thanks. Bye.